You don't need a finance degree to invest successfully, but you do need to understand the language of the market. In this beginner's guide, I'm going to walk you through every important stock market term, from basics like stocks and dividends to more advanced concepts like valuation, risk, and market cycles. I'll show you how these terms fit together, what you can safely ignore as a beginner, and how to use this knowledge to avoid costly mistakes and invest with clarity. Think of this as your plain English roadmap to the stock market. But first, who am I? I'm Jacob Wade. I'm a financial coach, and I'm currently a partner at WallStreetZen.com, where our quant team analyzes over 4,600 stocks daily. And if you like this topic that I'm presenting today, go ahead and give the video a like, hit that thumbs up. It'll help me plan future videos, and it'll share this with more people that you think would be interested in learning about the stock market. So let's start by talking about foundational stock market concepts and terms. You probably already know that when you buy a share of Apple, you're not buying a lottery ticket, you're buying a piece of a real business. So let's talk about what a stock or a share is. Now, these words mean the same thing. It's essentially a unit of ownership in a company. One share of Apple means you're a part owner of Apple. You participate when the company grows, and you suffer when it struggles. The investors who remember this simple fact, that stocks actually represent real businesses, tend to make better decisions than the ones who are chasing chart patterns or hot tips on social media. Now, you can own stocks in public companies and in private companies. Now, public companies, like the ones you know, like Apple, Microsoft, Coca-Cola, anyone can buy their shares on a stock exchange. These companies must report their earnings every quarter, giving you full transparency. Now, on the other hand, private companies like SpaceX or IKEA, those are owned by founders, venture capitalists, and employees. You can't just go buy shares of those private companies. And here's why this matters. So at Wall Street Zen, for example, our Zen rating system analyzes 4,600 public companies daily using 115 different factors. And we can only do this level of deep analysis because public companies give us the data. Private companies, not so much. Okay, next term, let's talk about your portfolio. Now, your portfolio is just a complete collection of your investments. So if you own Apple, Microsoft, and an index fund, that makes up your portfolio. It's not just about picking individual winners, it's about building a portfolio where the winners outpace the losers. Okay, I want to give you a few quick infrastructure terms. So a stock exchange, something like the NYSE or NASDAQ, think of them as Amazon for stocks instead of products. It's a marketplace where the shares actually trade. Next, let's talk about ticker symbols. So things like AAPL, TSLA, or GOOGL, this is the shorthand code for the actual stocks themselves. But if you're a beginner and you're executing a trade, watch out. If you don't actually verify that ticker symbol before you buy, you might end up buying the wrong stock completely. Very similar ticker symbols exist, so make sure you always double check. All right, let's talk about investment brokers. So companies like Schwab, Fidelity, eToro, these are platforms where you execute your trades. Now, most of these platforms now offer $0 commissions, but not all brokers are equal. So look for ones that have real-time data, access to research tools. Don't just go for the cheapest option, go for the one with the most capability. So those are the foundational basics. Let's talk about actually making money in the stock market and some terms you need to know. Now, there are two main ways that you make money in stocks: capital appreciation and dividend income. Let's break those down. So capital appreciation is basically when you buy a stock and then sell it for more than you paid. So for example, if you buy it at $100 and sell it at $150, that's a $50 profit, a 50% return. So the gain on that is called capital gains. And there's some actual tax implications here. So if you hold a stock for less than a year, for example, that gain is called short-term capital gains, and it's actually taxed at your ordinary income tax rate. That can be up to 37% on the federal level. But if you actually hold that stock for more than a year, you get preferential treatment, and it's taxed at long-term capital gains rates, which start at 0% and only go up to 20%, depending on your income. Now listen, I'm not your tax advisor, but I will tell you this: holding for 366 days to get that preferential tax treatment instead of 364 could actually save you real money. So just something to keep in mind. But on the other end, let's talk about capital losses. Listen, sometimes you sell a stock and you lose money. Even legendary investors take losses. It's just part of the game. But these losses can actually offset the gains on your tax return, and you can deduct up to $3,000 of ordinary income annually when you sell a stock at a loss. The key is cut your losses quickly and let the winners run. Now, even stocks highly rated by our Zen ratings quant system don't win all the time. This isn't a game where 100% is realistic. It's just not going to happen. But think about it like this. Like in baseball, we're happy when a player bats 250 to 300. In basketball, shooting 50% from the field is good. So in stock investing, it's similar. Even if you don't win all the time, you can still end up profitable if you cut your losers and you let your winners run and grow. All right, now let's talk about dividend income. Now, dividends are cash payments from company profits to shareholders. Usually these are paid quarterly, sometimes even on a monthly basis. So here's a real example. Johnson & Johnson pays about $5.20 per share annually. If you own 100 shares, that's $520 a year in passive income. Whether the stock price goes up, down, or sideways, those dividends are going to keep coming in. But not all companies actually pay dividends. Amazon doesn't, Tesla doesn't. They're reinvesting their profits for growth instead of paying them out as a dividend. So just something to keep in mind. Now, dividend yield is a calculation that's based on the annual dividend divided by the stock price times 100. So for example, if you get a $4 dividend on a $100 stock, that's a 4% dividend yield. Now here are some general rules of thumb on dividend yields. A 2 to 4% dividend yield, that's typical for a stable company. It's pretty good. A 6 to 8% dividend yield could be kind of high. I would investigate sustainability carefully before investing in this company. Now, a dividend yield of 10% or higher, that is a red flag. The dividend is likely at risk. Now, speaking of dividends, there are some long-standing companies that are known as dividend aristocrats. These are S&P 500 companies with 25 plus consecutive years of dividend increases. So Coca-Cola, for example, has done it for over 60 years. Other companies like Procter & Gamble and 3M, these companies have track records of stability through multiple market cycles, and they continue to increase their dividend over time. All right, now let's talk about your returns. So the term return on investment, or ROI, it's really simple. It's the current value minus your initial investment divided by the initial investment times 100. So for example, if you invest $1,000 and it's now worth $1,200, that's a 20% ROI. But when you're calculating ROI, don't make this beginner mistake. Don't just look at the price appreciation, ignore the dividends. The dividends are real income. So what you want to look at is what's called the total return. The total return equals the capital gains, right? That 20% gain plus any dividends received. And so you put those both together and you could have a better return on investment. All right, speaking of earning interest, the next term is compound interest. Now, Einstein called compound interest the most powerful force in the universe, and he wasn't wrong. Here's an example. If you invest $1,000 and earn 10% per year on that $1,000, after 1 year, your balance is $1,100. After 10 years, your balance would be $2,594. But after 30 years, that 10% return gets you to $17,449. Investing is not a straight line. It goes exponential. And this is why time in the market beats timing the market. It's not cliche, it's math. You want to let compound interest to work its magic and grow. All right, lots more terms coming, but if you're liking what I'm putting out here, go ahead and hit the subscribe button below. That way you'll know when I post the next YouTube video and you won't miss a thing. All right, now let's talk about valuation, because understanding what a stock is actually worth separates the amateurs from the pros. So the first term is market capitalization, or market cap. And it's the share price times total shares outstanding. So 1 billion shares at $100 each equals $100 billion market cap. Now, companies are typically put into different market cap categories. All right, large cap is companies with over a $10 billion market cap. Think Apple, Microsoft, the biggest companies in the world. Now, mid-cap companies have $2 to $10 billion in market cap total, and then small cap companies are around $300 million to $2 billion in market cap. Now, those are higher growth, but potentially higher risk companies. Now here at WallStreetZen, we analyze 4,600 stocks, but only go down to about the $100 million market cap mark, because below that, you have very volatile stocks with liquidity problems, meaning it's hard to sell them without the price going crazy. So that's about where we stop. All right, the next term is volume. Now, volume is the number of shares traded daily on a stock. Now, high volume means there's lots of interest, and it confirms the price moves and makes it easier to buy and sell a stock. Low volume means low interest. Now, the next term is liquidity. Now, liquidity is basically how easily you can buy or sell without affecting the price of a stock. So large companies like Apple or Microsoft, instant trades, tons of liquidity. Now, small companies can take some time to sell, and the size of your order could actually move the price of the stock itself. Now, my rule is this: just stick to liquid stocks as a beginner. If you can't exit your position, you can't sell a stock, you're going to be in trouble. So just make sure you go for stocks that have high liquidity. All right, now here are two numbers you need to understand. Number one is revenue. That's the total sales of a company before expenses. It's also called top line. The next one is net income. This is the profit after all expenses are paid. This is also called the bottom line or the earnings of a company. Now, the formula for this is the revenue minus all expenses equals the net income. Pretty simple. Now, both of these matter because revenue shows the size of the business, but net income shows if they're actually making any money. You could have huge revenue and still lose money. Many tech startups do this all the time, but you can also have low revenue and be very profitable. And so you need to look at both numbers when you're evaluating a stock. All right, next let's talk about earnings per share or EPS. This is the net income divided by the shares outstanding. So if a company has $1 billion in profit and 100 million shares outstanding, that's $10 earnings per share. Now, this is one of the 26 financial factors that our Zen ratings track, but here's what matters. Consistency in earnings per share growth over time beats one big blowout quarter. So make sure you're considering that when you're evaluating a stock. All right, now let's talk about the PE ratio or the price to earnings ratio. This is essentially the stock price divided by the earnings per share. So again, if you have a $100 stock price and $5 earnings per share, that's a 20 PE ratio. A PE ratio of 15 to 25 is typical for most companies. Now, a PE ratio of 30 plus can be expensive, or it's a high growth expectation company and it's already priced in. Now, a PE ratio under 15 either means the stock is cheap or the market sees a problem with the business itself. But again, those are very general rules. The norm for a particular industry might actually be very different than another. So make sure you never look at the price to earnings ratio in isolation. Compare it to the sector average, the company's history, and the growth rate. All right, next let's talk about the PEG ratio or price earnings to growth. It's basically the PE ratio divided by the annual earnings growth rate. So a 30 PE ratio with a 30% growth rate equals a 1.0 PEG. Here's a rule of thumb you can think about. A PEG of under 1.0 is potentially undervalued for the growth of the company. Anywhere between 1.0 and 2.0 is typically fairly valued, and a PEG of over 2.0 is expensive, even accounting for that growth. All right, now let's talk about intrinsic value. This is what a stock is truly worth based on analysis. But the challenge is it's subjective. Give 10 analysts the same company and you'll get 10 different intrinsic values. Again, this is another reason we use 115 factors in the Zen ratings. No single calculation can really capture everything. You need a comprehensive view. All right, next let's talk about actually buying and selling stocks, the mechanics of actually executing your trading strategy. So here's the basic orders you'll need to know. Number one is the market order. You can buy or sell shares immediately at the best available price on the market using a market order. Now, it's best to use market orders when you're trading liquid stocks during regular market hours. Otherwise, you might end up paying or receiving amounts you did not expect. The next type of order is the limit order. This is a safer option compared to the market order, where you can trade stocks only at your specified price or better. So, for example, if the stock is trading at $190 per share, you set the buy limit order at $185. Your order waits until the price drops to $185. This gives you more control over the price that you are paying, but there is a risk that it'll never drop to that price and your order will never be filled. Now, I recommend limit orders about 90% of the time because I like to control my entry price. That matters when you're investing in stocks. All right, next up is the stop loss order. Now, this type of order will automatically sell the stock if the stock falls to your trigger price. So, for example, if you own a stock at $50 and set a stop loss order at $45, this limits your downside to a $5 loss. And it allows you to manage your risk and avoid emotional trades when prices are moving fast during volatility. But make sure you be careful with this one because your downside trigger price might be executed during short-term volatility and then the stock recovers and you're left out. The next type of order is a trailing stop. This is a stop loss order, but it adjusts upward as the stock price rises. Now, the benefit to this is it locks in gains while allowing the upside of the stock. Now, my take is it's a good concept, but In practice, most beginners set them too tight and they get shaken out of winning positions. Now, there are other order types: day orders, good till canceled orders, fill or kill, but honestly, master marketing limit orders first. The other stuff can wait. All right, let's talk about stock categories. Now, not all stocks behave the same way, so understanding these categories can help you build a better portfolio. Now, let's talk about common stock versus preferred stock. Now, when you own common stock, you're the shareholder and you hold a fraction of the company. You have voting rights, eligible to receive dividends, if any, and your holdings have an unlimited upside potential. This is 99% of what you're going to trade. Now, preferred stock is some kind of hybrid instrument between debt and equity. They usually pay fixed dividends and you have priority in the event of bankruptcy. However, you have no voting rights. Now, this is way less common for retail investors, so you're typically not going to be investing in preferred stock. Now, while you might see many different categorizations based on company characteristics, here are the most frequently used ones that you'll likely hear a lot about in your investment journey. So the first term is blue chip stocks. These are large, stable, financially solid companies such as Apple, Microsoft, Johnson & Johnson, and Coca-Cola. These are industry leaders that weather storms. They typically have lower volatility and are a good foundation for beginners. Next up is growth stocks. And these are companies that everyone expects to grow faster than the average business. So instead of paying dividends, they typically pour their profits right back into themselves by expanding, hiring, building, innovating. They usually trade at high valuations because investors are betting big on the future. Think historical Amazon stock or Tesla back in its early years. This is high risk, but high reward. All right, next up is value stocks. Now, these are the market's mispriced opportunities. Solid companies that are trading below what they're really worth, and often they're just temporarily out of favor with the market. These ones typically have lower price to earnings ratios when you're looking for them. All right, dividend stocks. These are companies that share their profits with you. They send out regular cash payments to shareholders straight from their earnings. Now, this is best for income investors and retirees, but the trade-off is they usually have lower growth and they're more stable, not as volatile, not as high explosive growth. Okay, so different stocks react differently to the economy, and knowing which one is which can change everything. So cyclical stocks, things like airlines, hotels, car manufacturers, luxury goods, they boom when the economy is expanding, but they bust when there's a recession. Now, defensive stocks is a term you'll probably hear. These are things like healthcare, utilities, consumer staples like food and hygiene products. These are pretty much stable in any environment. And you might have already heard about penny stock or speculative plays. They have cheap shares. Usually their stocks priced under $5 per share and under a $100 million market cap. They do have poor liquidity, there's high fraud risk, and there's extreme volatility. So my blunt take on this: if you're a beginner, avoid volatile penny stocks. There's too much speculation and not enough substance. Now, that said, there are low price stocks with solid fundamentals that may be worth your time. Of course, make sure you run them through a system like our Zen ratings to help you vet the ones that are actually any good and worth looking at. All right, now let's talk about market conditions. Understanding market conditions gives you context for your decisions when you're investing. So first up, let's talk about what a bull market is. This is signified by rising prices, investor optimism, and economic growth. Now, the investor behavior during a bull market, people are typically risk on, meaning they buy more risky stocks. There's a lot of FOMO and piling into certain investments, and there's just a whole lot of optimism all around. Now, to contrast that is what's called a bear market. This is signified by a 20% or more decline from recent highs in the market and widespread pessimism. Now, these are shorter in duration, but they're more intense than a bull market. Now, an example of a recent bear market was in 2022. The S&P 500 was down around 18%. The Russell 2000 was down 21%. And Cathie Wood's ARK Innovation Fund, with everyone's favorite growth stocks, that was down 66%. So that's an example of a bear market. Now, let's talk about a correction in the market versus a crash. At first glance, they might sound similar, but they are very, very different. So a correction is simply a 10% or more decline. This is normal, healthy, happens every 1 or 2 years on average. But a crash is a sudden and severe drop in the market, often 10 to 20% or more in just days. So think Black Monday, 1987, COVID, March 2020. And I've seen a few of these in my time. Corrections can be good buying opportunities if your stocks maintain strong fundamentals. Now, crashes require nerves, of steel, but they also create once-in-a-decade opportunities. So make sure you know the difference between both of those. All right, next, let's talk about volatility. Volatility measures how wildly a stock price swings up and down. Now, tech stocks and small caps are usually highly volatile. They make large swings, while a few sectors, such as utilities and consumer staples, have low volatility. They have very stable stock prices. Now, volatility isn't always bad. It creates buying opportunities for disciplined investors. All right, next, let's talk about beta. This measures a stock's volatility relative to the market itself. Beta equals 1.0. This moves with the market. Beta over 1.0 means it's going to be more volatile. A 1.5 beta means if the market moves 10%, the stock typically moves 15%. Now, a beta under 1.0, that's going to be a lot less volatile. So when you see beta scores, that's what you're looking for. Now, let's talk about risk. Now, risk tolerance, this indicates how much volatility you can psychologically handle. So here's a question you can think about. Would a 20% drop cause you to panic sell a stock? And be honest with yourself. Then, once you know the answer to that question, match your strategy. So if you have a high tolerance for risk, you can invest in small caps, AI growth. You'll see 40 to 90% annual returns, but very high volatility. Now, if you have a medium tolerance, you probably want momentum or value stocks. Again, around 25 to 35% returns, potentially moderate volatility. Now, if you have a very low tolerance for risk, you're going to invest in things like large cap or income funds. And again, this could be 16 to 20% returns depending on your strategy, but much lower volatility. All right, now let's switch it up and talk about market behavior patterns. Let's first compare overbought versus oversold. Now, overbought simply means the price of a stock has risen too far and too fast. There's been too many people purchasing it, and the price is going to come back down eventually. Now, on the other end is oversold. The price has dropped significantly, and there has been too much selling pressure, and the price will probably return to the mean and end up coming back up a little bit. It's good to know these trends and keep an eye on them so you don't buy a stock at the wrong time. All right, speaking of prices rising, let's talk about market bubbles. This happens when prices far exceed the fundamental value of stock. So some classic examples of this include the dot-com boom, the housing bubble of 2007, and then the crash in 2008, or the crypto bubble in 2021. Now, warning signs of this time is different narrative all over social media, especially things like x.com. So if you start seeing that, you might be in a bubble. All right, now let's talk about investment vehicles. These are different ways to get exposure to the stock market when you're investing. So first, we're going to talk about funds. Now, ETFs are very popular, exchange-traded funds. These are baskets of stocks that trade like a single stock on exchange markets. So the benefits of ETFs are you get instant diversification, access to hundreds of stocks at a time, potentially. They have very low fees and they're liquid. You can trade these all day. An example of an ETF is SPY. This tracks the S&P 500 index and owns all 500 companies. Or QQQ, which tracks the NASDAQ 100 index. Now, my take on this is I recommend beginners start with broad market ETFs like VTI, Vanguard's Total Stock Market Index Fund. You can own the entire markets while you're learning. Now, speaking of, let's define the term index fund. Now, this is a fund that tracks a specific market index. Now, the philosophy behind it is to match market returns and don't try to beat them. And there's studies out there that show that index funds outperform over 80% of active managers over 10+ year periods. Fees are typically the lowest available, typically 0.03% to 0.15% per year. Now, on top of index and ETF investing, you can blend in active trading strategies for potentially higher returns. While index funds get you market returns about 10 to 11% annually, strategies like Zen strategies could get you 16 to 48% annually, depending on which one you choose. And that difference can compound dramatically over decades. So $10,000 into the S&P 500 since 2003, it's about $65,000 today, not bad. But $10,000 into our A-rated stocks since 2003, over $6 million. All right, now our final funds we're going to talk about are mutual funds. Now, mutual funds are similar to ETFs. They're baskets of stocks or bonds or other securities that you can buy in a single fund. Now, the difference between mutual funds and ETFs is that mutual funds are priced once daily. And when you purchase a mutual fund, it takes the price after the market closes. And sometimes they have higher fees, sometimes they're tax inefficient, and sometimes they have high minimums to get into. Now, ETFs, again, they could hold the same stocks, the same portfolio, but you could trade them all day. They're typically lower fee and they're more tax efficient. So my personal preference, ETFs for most investors. All right, let's talk about REITs, Real estate investment trusts. This allows you to own real estate without actually having to buy property. So the holdings inside these REITs are things like apartments, malls, offices, data centers, commercial real estate property. And the cool thing about REITs, they're required to pay 90% of the profits as dividends to REIT investors. Now, on a quick tax note, REIT dividends are taxed as ordinary income, and they're at a higher rate than qualified dividends. So they're still a good investment, but you need to make sure you understand the potential tax implications of owning these REITs, or maybe even just put them in tax-advantaged accounts to protect from taxes. Now, there are all kinds of other advanced investing instruments like options, futures, bonds, hedge funds. Look, we're going to ignore these completely for your first 1 or 2 years. You just need to master stocks and ETFs first, and the other stuff could wait. All right, now let's talk about analysis. How do you actually evaluate stocks to buy and sell? Now, there are two main approaches to analyzing stocks. You have fundamental and you have technical. Let me explain both and how we can combine them to take advantage of both at the same time. Now, fundamental analysis is evaluating a company's real business performance and financial strength to understand what it's truly worth. Key metrics you want to look at include revenue, earnings, debt, cash flow, competitive position, and even management quality. Now, when you're doing fundamental analysis, the time horizon you want to look at for this method is usually long term. We're talking months to years. The intrinsic value you calculate may take time to be reflected in the stock price itself. Now, the most famous practitioner of fundamental analysis and value investing is Warren Buffett, and it's worked out pretty well for him. Now, I also want to make sure you know how Zen Ratings actually implements fundamental analysis into our score. So we have 26 financial factors, including return on equity, return on assets, debt ratios, R&D spending, profit margins, and we have 23 growth factors that include revenue, earnings per share, cash flow, profit margins, EBITDA. All of it is measured for consistency over time. We also have 21 value factors. We have the PE ratio, the PEG, the price to sales, price to book, EBITDA, and more. So in total, 70 of our 115 factors alone are fundamental analysis. Now, let's talk about technical analysis. Now, technical analysis is using charts, price patterns, and market trends to forecast where a stock might move next. Now, some key tools you would want to use to do technical analysis include looking at moving averages, RSI, Relative Strength Index, MACD, and support and resistance levels to spot trends and potential entry or exit points. Now, the core belief of technical analysis is that the price already reflects all known information, so analyzing the price action itself is enough. And the time horizon on technical analysis is usually short or medium term. For investors, usually look at only a few days to maybe several months of data. So when you're doing technical analysis, let's talk about some common indicators you might come across. One is moving averages. These are the smoothed price trend. 50-day and 200-day are popular. The RSI, the Relative Strength Index. This tells you whether something is overbought or oversold. It's how it's measured. Support and resistance. These price levels are where the stocks tend to bounce or stop. So support would be the bottom level it bounces off of. Resistance is the top level it bounces down from. Now, here's my take on technical analysis. It helps inform when to buy. You want to look at it, but it doesn't tell me what to buy. That's why it's only a single piece of the puzzle, and trading on technical analysis alone is really gambling. It's not investing. So here's what you want to do. You want to do fundamental analysis and find companies that are worth even looking at investing in. Again, you could just put any stock ticker into Zen Ratings on WallStreetZen.com and find one that has a high rating, a B or an A rating. Then you can go over and look at the charts and start to do technical analysis to figure out at what price point should I enter purchasing this individual stock. You're combining the power of fundamental and technical analysis together to figure out when and what to buy. All right, now let's talk about risk management. Now, risk management is highly important and separates the professionals from the gamblers. First things first, let's talk about leverage and margin. Now, leverage is using borrowed money to increase your position size when you're investing in a stock. That means borrowing money to invest more in a specific stock. The problem is it magnifies your gains, but also magnifies your losses. So for example, let's say you have $10,000 and you borrow another $10,000. Now you have a $20,000 position in a stock. If that stock goes up 10%, you make a $2,000 profit. That's a 20% return on your money. Great. But if the stock goes down 10%, you lose $2,000. That's a 20% loss on your money, and you still owe the borrowed amount back. That is not great. So leverage really is a double-edged sword. Now let's talk about margin and having a margin account. This is essentially a brokerage account that lets you do the borrowing. So a typical margin account gives you what's called 2-to-1 buying power. So a margin account you would open, and that's when you would start to borrow funds to purchase shares of stock. Again, it is a form of debt, and you would have to pay back what you have borrowed. And if the price goes down, that means more money out of your own pocket. So use caution. So here's my take on this. Beginners, do not use margin, do not use leverage, just invest directly. I've seen professionals, even smart people, blown up by using margin. Listen, you can make plenty of money without borrowing. Just don't add that risk. All right, now let's talk about managing your portfolio. Some other parts of risk here. Number one is diversification. You've probably heard this. Diversify. Spreading your investments across different assets instead of putting everything into one place gives you diversity. Again, investing in something like an index fund in the S&P 500 allows you to own 500 stocks instead of just one. Now you are diversified. But more than just stocks, you can even diversify into different sectors of the market, into different asset classes, and even into different countries and have global diversification. The entire goal is if one bad investment goes down, it doesn't seriously damage your entire portfolio. Now, another piece of risk, we're going to talk about when to sell. And this is a discipline that most investors struggle with. And adding to the confusion, there's not really a clear answer on this. It might be different for a short-term trader or a long-term investor. You can go to Zen Ratings and use this example method. This is for a short-term trader with 6-month or shorter trading time horizon. Now, if you're a long-term investor and you have a 6-month or more time horizon, here's the strategy. Again, you're going to go to Zen Ratings and you're going to buy an A-rated stock. You're going to hold that for a minimum of at least a month. Now, if that A-rated stock falls to a grade C or below, then you would sell and rotate that money into a new A-rated stock. Now, why would you hold a B-rated stock if it dropped? Really, it's because they're still impressive outperformers in the top 20% of all stocks analyzed on Zen Ratings. So to squeeze out the maximum long-term gain, it's best to hold when it's still an attractive B-rated stock. But once it becomes a C-rated stock, it's time to sell in order to find a new A-rated position with vastly better upside potential. Now, if that sounds too complicated, we have a Zen strategy service that has a simple solution. We automatically rebalance it every 4 weeks. So if a stock drops to a C rating or below, sell it, replace it with the highest rated stock in the strategy. Now, why does this work? It removes emotion, it enforces consistency, and it cuts losses without second guessing. Now, for individual stock pickers, using the free Zen Ratings system, if a stock's rating drops to C or below, reevaluate immediately. Or if it's a DNRF rating, sell now. Don't fall in love with losers. All right, now let's talk about some behavioral traps to avoid. You've probably heard of FOMO, the fear of missing out. This causes you to buy something just because it's trending on social media, but not actually because of research. And the problem is, once you hear about it, it's already at the top and you're buying when it's peaked. History shows it too. The dot-com bust, the housing crash, crypto. Investors that FOMO'd took years to recover and some never did. So don't fall into this trap. All right, the next trap is called a pump and dump, a form of market manipulation. People hype a stock, then they sell it off at its peak, and they leave retail investors with the losses. Now, some warning signs of a pump and dump scheme are unsolicited tips or sudden hype on social media around a penny stock or a crypto or something that you haven't heard of before. So to protect yourself from this, just stick to strategies that have proven track records. And speaking of proven track records, I put together a free report of our stocks on our Zen rating system that have been identified as having a 2x or more potential in the coming year. So click the link in the description for the double report or scan the QR code right here on the screen to get it at no cost. All right, we've been through a ton of stock market terms. Now, here are a few things you should probably just avoid as a complete beginner. Now, you can explore some of these after you've established a trading foundation, but I suggest avoiding these things when you're a total newbie. Number one is options and derivatives. 99% of beginners lose money here, so don't worry about those right now. Number two is day trading. Even pros struggle to beat indexes, so don't bother with it. Number three, we've already talked about penny stocks. There's just a high risk of fraud manipulation. There's liquidity issues, just not worth it. Next is margin and leverage. Again, we talked about that. It can amplify your losses just as much as your gains. Next is complex technical indicators. Just start with the fundamentals and the basics. You don't need to get complex. Next is any get-rich-quick scheme. If it sounds too good to be true, it is, especially when it comes to the stock market. Next is any hot stock tip you get from social media. Listen, FOMO kills returns, so just don't follow the hype. It's not worth it. Now, here's some things you should probably also just delay learning until you've mastered the basics of the stock market. Advanced technical analysis, sector rotation strategies, futures and commodities, international markets, alternative investments like crypto. Just focus on the basics first, master them, and then you can expand. Now, if you just want the easy button, of course, you could just use Zen ratings. Again, we use 115 factors because no single metric is going to tell the whole story. You can't just look up PE ratio alone. It's going to miss growth trajectory. Momentum alone, catches falling knives. Or if you just look at value, you get stuck into value traps, which we already talked about. So our solution is a comprehensive 360-degree view. Now, we solve the 3 flaws of traditional value investing. Now, flaw number 1 is value traps. These stocks are cheap for a reason. And so we have 26 financial factors plus 23 growth factors that filter out deteriorating businesses. Flaw number 2 is classic value metrics that just don't work alone anymore. So we have 21 different value factors stacked together and equals a consistent edge over time. And flaw number 3 is just a lack of timeliness, and it can kill your return on investment. We have 22 momentum factors to ensure that our stocks are actually moving in the right direction when we recommend investing in them. And again, our A-rated stocks on the Zen rating system have a 32.52% average annual return since 2003. $10,000 invested in 2003 grows to over $6 million today. 21 of 22 years outperforming the S&P 500. That's not luck. That is a system that works. So again, you can find that on WallStreetZen.com. Just look up any stock. You'll see the Zen ratings right there. All right, there you have it. Some of the most important stock market terms. Did you learn anything new today? Or maybe did I miss anything big here? Leave a comment below and let me know. And again, if you liked this video, put your newfound knowledge to work by learning how to read a stock chart. You can find all the details of it in this video right here.